Hi, I'm Steve Johnson, Chief Investment Officer here at Forager Funds, and I'm joined today by Gaston Amoros to have a chat about a very, very topical topic, and that is the coming tsunami of fixed-rate mortgage rollovers that Australia is going to experience over the next couple of years. Been an interesting start to the year for the market, Gas. We've got the All Ords up something like 5-6%, Small Ords for a change over the past couple of years doing even better than that. And some interesting results from companies like JB Hi-Fi, for example, coming out with what I would say were some pretty surprisingly positive sales results.
Yeah, that's right. So we were all waiting for, I think the market in general is waiting for weakness in consumer stocks, and that weakness seems to never come. So in the case of JB Hi-Fi, it's a good example. They reported sales that were 9% higher than the last year. EBIT or NPAT, you know, whichever measure of profit you want to look at, it was 15% higher than last year. And it took margins to almost record in historical terms. And that's on top of a level of sales per store, which is way above what it used to be pre-pandemic, right? So when you look at that picture, you think, wow, I mean, this is as good as it gets, and it possibly is as good as it gets when we look at what's coming down the pipe, right? Particularly in terms of housing.
Yeah, well, we've been saying that it's got to get more difficult, and I think our general model here has been to at least assume reversion back to 2019 plus whatever a company was growing at, because most businesses have experienced that, but JB Hi-Fi is showing that the consumer is still spending out there for now. So let's dig into how that can be, and I guess how it's going to change over the coming years. The RBA put out a financial stability report, I think that was in November or October. Yeah. You can Google it. I think the whole report is really worth a read for people out there, but there's a lot of data that I guess explains a little bit of what's happening here, but more importantly explains how the pain of these interest rate rises that we've already felt is going to be felt over the coming couple of years. It's a pretty interesting situation here in Australia. If you compare our fixed rate mortgages, it's a lot higher than it was a couple of years ago because the government was specifically funding 3 and 4 year mortgages through COVID, but still relative to the US, we're a country of more variability than you have in the US. Can you maybe just touch on the typical duration of loans here in Australia?
So I think you're referring to the fixed side of the loans, and it's interesting, 40% of the outstanding loans, I think it's in the same report, 40% of the outstanding loans were generated over the last 2021 and 2022. That's a huge amount of loans that originated at higher prices, at very high prices. And I think, so Australia has, you were referring to...
You mean higher house prices there?
Yeah.
Yeah, but right. Was all of that 40% for buying a new house, or was some of that people just going, interest rates are low and I want to lock it in?
Yeah. But you will have refinanced at a at a much higher price, right?
Yeah.
And I think around 20 to 25% of the outstanding loans of the overall outstanding loans are at a fixed rate, and and the average tenor when it comes to fixed rates is 2 years. So that means it's all coming to a head pretty soon.
Yeah, and that's in stark contrast to the US, where almost all mortgages over there are 30-year fixed rate mortgages. And in some ways, there's pros and cons to that. I think you are going to need to push interest rates higher in the US to have the same effect on the economy that you have here with much lower rate rises, simply because they have far more fixed mortgages. So it's not making any difference to all of the people who have got these 30-year
we feel it
mortgages
very
in the US. So we do have more fixed than usual, and it's starting to roll off. Can you maybe just talk through the magnitude here of what we've already experienced? If we just total it all up, what's the total amount or the impact on people's incomes here that we're going to see from these rate rises?
So, well, there's a couple of ways of looking at this, but one of them is, imagine interest rates went from 0, where they were, to 4% on the cash rate, which is where the interbank future has the rates pegged by the end of or by middle of this year, or almost 4%. So when you apply a 4% increase on 2 trillion worth of housing loans from families, that basically 80 billion with a B of headwind to the consumer, which is roughly 10% of gross income for the household sector. So that's a quite steep headwind.
Yeah, so when you say gross income there, I just want to define it really quickly, because the RBA uses a term that's called disposable income, and when I hear that, it sounds to me like it's what I've got left after I spend everything that I need to spend, but they actually just mean your income less your taxes.
Correct.
How much money have you got to spend, not just on things that I would call disposable spending. So what you're talking about here is a 10% of people's incomes in aggregate is going to go towards paying higher interest payments.
Absolutely.
Once all of these new loans roll through.
And that will be, the number that I mentioned is gross. So when you put it in terms of net, it will be way higher number of net. So that's a really powerful headwind. Just to give you a sense, for the average home borrower on a fixed rate loan, that means that the monthly installment is going to go up by around 40% when all these rate rises are passed through. And that's 1/3 of the market. Then you have the other 2/3 of the market which are currently variable, and those guys will feel the same increase in installments. So it'd be like 30, 40, 50%, but they'll feel it over just gradually, right? Whereas for the guys that come out to refinance, they will just feel it in one fell swoop, up 40%.
Another good metric for people that are just trying to understand the magnitude of things out there is that in Australia we have household debt that's about 120% of GDP, so almost 1-to-1 in terms of GDP. So each 1% rate rise is 1% of GDP that is going to go on higher interest rates, and that is more debt than most other countries in the world. We have a quite indebted household sector here. The RBA also, and I think this explains JB Hi-Fi in general, positive consumer spending recently, but they provided a really nice chart that shows you the exposure of the current cohort of fixed rate loans. You can sort of trace it back to COVID. If you took out a 3-year mortgage in 2020 or 2021, or a 4-year mortgage like you and I in 2021, those fixed rate loans are not really starting to expire yet. And this is a really nice chart from the RBA that shows you the big hit comes in June. The June quarter of this year is where the largest cohort of people are going to be paying substantially higher interest rates as those fixed rate mortgages roll over.
Correct. So 50% of all the fixed rate loans are coming for refinancing in 2023 at some point, like the majority, as you said, in June and September quarters.
And then the June, September quarters, and then the rest through 2024. So this is not a hit that's going to be a one-off bang and there's a massive change in consumer spending instantaneously. It's going to be 2 years here, I think, of fairly meaningful cuts to different cohorts of people's ability to spend. Now look, this doesn't mean everyone's in trouble. At the moment, employment is very, very strong, and in particular employment for people that probably don't have mortgages. Can you talk us through that part of the economy here that is not as exposed to these mortgage rates?
Well, so home ownership in Australia is around 65% of the population, so that basically means there's a 1/3 of the population that rent and for whom this is just a topic in the newspaper. So, first thought doesn't have much impact for them. And on the flip side, they'll see it as a positive because, home affordability is getting better, right? So their prospects of buying a house are actually getting better. As long as they keep a job, right, of course, and as long as their salaries keep pace with inflation, the inflation that we had over the last couple of years, and so far that's been the case. So you could say that there's a segment of the population for whom this is not a big issue.
Yeah, and the other factors on the other side of the ledger here are wages are growing quite strongly, and if you've got higher mortgage payments coming, but your salary is up 10 or 15% by the time that happens, that helps. And the other huge lever that people have to pull or gets pulled in aggregate is the savings rate in the economy. It went as high as 20% through COVID because people didn't have a lot to spend money on. We're getting huge stimulus from the government. That has already come down quite substantially though, and if you look at this chart that we have up in front of you now that shows the savings rate here in Australia, we're getting back pretty close to historical lows. It can still go a bit lower from here, but we're getting close to the point where it's the spending that needs to change rather than the savings rate to accommodate these rises in interest rates that are coming through. Look, there's a lot more to discuss here, and we probably will over the next 12 months. From an investing perspective, I think at the moment it's still really, really hard. I don't think share prices are low enough to be saying, well, I'm happy to take on all of this risk and uncertainty about how the consumer behaves over the next 12 months. JB Hi-Fi, I think, is an example of a really good business. The market's not pricing it to stay at current levels of profitability forever, but it's also not pricing in any sort of retraction back to 2019 levels either. And that's true, I would say, across most of the retail space, that it's not priced stupidly expensive, but they're certainly not cheap enough in our view to take on the uncertainty of what we see coming over the next 12 to 24 months.
Yeah, particularly if you think that that earnings estimate that is embedded in the numbers is going to be revised down, right? Correct.
Yeah. So we're probably going to get a pretty positive reporting season, this period, from what we've seen so far. It's not going to be until June and July that you start to see the warnings coming out. But on the basis of what the RBA's put out there and these numbers that we've put in front of you today, that's really because the pain is yet to be felt. Thanks for tuning in.